Welcome to Investment Week's 5 Easy Pieces, a look back over the news of January through 5 different lenses. Targeted absolute return faced yet another year hemorrhaging cash, as £12.6 billion flowed out from the troubled sector. The third year in a row, more than £10 billion has been withdrawn. In 2018, the sector saw outflows of £14.1 billion, despite only 11 of 119 funds recording a loss for the previous year. 2019 saw investors withdraw £23.9 billion from TAR, following a sudden market contraction the previous year, which resulted in more than 85% of funds in the sector recording a loss, further knocking investors' faith in the proposition. The outflows continued last year, despite the average fund in the sector returning 2.6%, only 70 basis points lower than the average fund in the IA Global Equity Income sector at 3.3%. Industry commentators have asked if the funds cannot keep their promise under positive market conditions, how can they be trusted to perform in strained market conditions? Others take a different line, believing there remains a place for targeted absolute return funds within a diversified portfolio, but as ever, fund selection remains crucial. ESG flows outweighed non-ESG for the first time ever last year, with ETFs holding green, socially conscious or good governance credentials attracting €45.5 billion compared to €43.8 billion that flowed to passive products without an ESG label. However, a report from Track Insight released on the 18th of January revealed fewer than half of all ESG ETFs are aligned to any of the 17 United Nations Sustainable Development Goals. This means that more than $100 billion of ESG assets are non-UN SDG products. On the 20th of January, just hours after becoming the 46th President of the United States, Joe Biden began the process of rejoining the Paris Agreement on climate change and stopped the process of leaving the World Health Organization via executive order. The new administration, which has appointed John Kerry as the first ever United States Special Presidential Envoy for Climate, has said it will combat climate change in a way that we have not done so far. And on the 26th of January, in his annual letter to corporate leaders, BlackRock CEO Larry Fink called on all companies to disclose a plan for how their business model will be compatible with a net zero economy. He defined this as limiting global warming to no more than 2 degrees above pre-industrial averages and eliminating all greenhouse gas emissions by 2050. On the 5th of January, Aegon Asset Management hired Lindsay Hudson as its first ever head of inclusion and diversity, with global responsibility for driving positive change internally and externally. Hudson, who is a steering committee member of the Diversity Project, will engage internally on inclusion and diversity issues while advocating for change externally. On the 18th of January, a team of ethnic minority allies from across the asset management community launched a new campaign to spotlight the success stories of BAME people in the industry. Reboot aims to use the power of storytelling to offer members of the BAME community role models within the financial industry, as well as to support positive dialogue regarding racial inequality in the workplace. It will begin by releasing a series of video interviews on LinkedIn over the coming weeks with ethnic minority professionals. On the 26th of January, former US Federal Reserve Chair Janet Yellen became the first female US Treasury Secretary. Yellen, who was the central bank's chair between 2014 and 2018, will be responsible for guiding the Biden administration's economic response to the pandemic. Finally, Man Group's Group COO and General Counsel Robin Grew spoke to Matt Cameron from Investment Week partner LGBT Great about the Holocaust and what we must learn from the pain that was endured in an interview marking Holocaust Memorial Day. Aviva Investors began the year appointing Mark Versey CEO as Ewan Munro departed on the 4th of January to take up the role of Chief Executive at Newton Investment Management from the 23rd of June, subject to regulatory approval. This was not the only new role for Versey, who joined the Investment Association's Board of Directors later that month. 2 weeks later, on the 20th of January, EdenTree tapped former Head of Strategy, Environment and Sustainability at Jupiter Asset Management, Charlie Thomas, as its new Chief Investment Officer. So began a busy week for HR teams as Columbia Threadneedle hired Michaela Collett-Jackson from BlackRock to become its new head of distribution for EMEA. TJ Voskamp left Aviva Investors to become J.O. Hambro Capital Management's head of sales and distribution across the UK, Europe and Asia, and Victoria Hasler said goodbye to Square Mile, leaving the firm to become EQ Investors' head of fund research. January was a full month for internal moves too. Davina Rich became Brewin Dolphin's new head of research as Guy Foster was appointed chief strategist. Katie Trousdale was promoted to head of multi-manager strategies at Aberdeen Standard Investments, and Andrew Hardy took on the role of investment director at Momentum Global Investment Management. At Hargreaves Lansdown, Kate Marshall will lead the research team during Emma Wall's maternity leave, which began on the 16th of January. The saga of an online forum taking on Wall Street via an outdated games retailer dominated much of the January news cycle to the surprise of pretty much everyone. Our Wall Street Bets, which describes itself, like 4chan found at Bloomberg Terminal, launched a coordinated attack on hedge funds betting against GameStop, resulting in a short squeeze and the forum's primary target, Melvin Capital Management, sustaining a 53% loss over the course of January. The movement was made possible by commission-free trading apps such as Robinhood, which enables its customers to utilize derivatives trading alongside more traditional stock buying. These apps have themselves come under the spotlight following the decision to halt the purchase of certain highly traded shares, including GameStop. The story is far from over, with both the House and Senate committee pledging to hold hearings on the GameStop affair, and although the price of the stock has fallen from its intraday high of $483, its current $67 price is more than 3 times higher than it began the year. Whether the phenomenon is a new factor for market participants or simply a rerun of the 1990s day trading boom remains to be seen, but a consensus is emerging among professional investors that this will not be the last time markets are rocked by newly empowered retail investors.